Hello everyone, and thanks for joining me for another video. I've been so excited to make this one because I have two big announcements. The first is that I've decided to change my strategy from using the dividends to pay back the loan to instead reinvesting the dividends. I'll go over my reasons for this change with a nice spreadsheet I've created that compares the two options. The second news is that I've taken out even more money to invest, and I'll show you where that went. So let's get into it. When I first started this 4 months ago, I wanted to borrow money, invest it, and use the dividends to pay back the loan. The goal was simple. Can I make money without using any of my own money? After 3 months of that, the answer seems to be yes. I mean, sure, it'll take a while, but each month I was averaging $345 in dividends, while the interest was $157, allowing me to pay $188 per month to the loan principal. Eventually, the loan will get paid off without using any of my own money. Now, let's look at this other Excel spreadsheet I've created. Just a quick note, I'm using an 8% return, which I'm not currently receiving with the original 6 stocks I chose. It's probably more around 6.5%, but I'll explain why I'm using 8% a bit later in this video. So with an 8% return, it will take me 16 years to pay off the loan using only its dividends. In this table, I have the year, amount of yearly interest, yearly dividends, the loan value, and the difference each year. Going through the years, the interest goes down while the amount I'm able to put on the loan increases. And that's exactly what we want. At the end of 16 years, I'll have a free $65,000 and a monthly income of $433. Now let's look at the other side where dividends are instead reinvested and I use my own active income, the money I make from going to work each day, to pay the interest on the loan. Note that I'm not paying down the loan, I'm only paying the interest. So again, we have the year, the interest, which is the same each month since I'm not paying any of it down, yearly dividends, along with the amount in monthly dividends. There's a column for any money I do want to put down on the loan, and the portfolio balance. You could see that with each passing year, the dividends increase because I'm using them to buy more shares, which in turn pays me more dividends. I always knew that reinvesting dividends would be a better return, but I didn't know by how much. So in the first scenario, I'll end up with $65K and $433 per month. But by reinvesting the dividends, after the same amount of time, I'll end up with $127K and $1,051 per month. The monthly dividend has more than doubled. Now to keep things apples to apples, I did subtract the interest I paid on the loan, and I subtract the loan amount from my overall returns. Looking at this blew my mind, and there was no question I have to start reinvesting the dividends I'm receiving. To start with, I went ahead and withdrew an additional $40,000 to max out my TFSA. Now the question was, where should I put them? I made a list of 20 or so stocks that I would ultimately like to be invested in. These include the original 6 I invested in, other blue chip companies, and ETFs. With my original investment, I didn't want ETFs. I chose individual companies because the plan was to have those 6 companies for 16 years, and I wanted them to grow at a higher rate than the amount ETFs grow. But now that I'm reinvesting the dividends, I want high yield early on, which will bring in more money that I could then use to buy more stocks. So now that I have a list of 20 solid stocks, I sorted by the highest yield, and the top 5 really stood out to me. They were Ryokan, Enbridge, BMO US Banks ETF, BMO Canadian ETF, and BMO Europe ETF. At the time, these were all paying a 9 to 10% yield. I like the diversity that those ETFs bring, giving me slight exposure into the US and European market. So my plan was to put $10,000 in the top 4 yielding stocks, and with the dividends those 4 give me, I'll reinvest into BMO Europe until that's up to around $10,000. Now let's hop back to my Excel sheet comparing paying off the loan to reinvesting the dividends. I borrowed a total of $105,000, and the yield? So this is where these new stocks come in. With my previous 6 stocks, the yield was on average 6.5%. With these 4, the average yield is close to 10. So let's go with an average yield of 8%. Now let's compare. At the end of 16 years, instead of having $105,000, I'll own $205,000. That's almost double the amount. And instead of having $700 a month, I'll have just under $1,700 per month. $1,000 more. That's impressive on its own, but remember, to keep apples to apples, I subtracted the loan on the second chart. If I choose not to pay back the loan and continue to pay the interest with my own active income, the new totals will be $310,000 and $2,400 per month. I can't even describe how great it would feel to get an extra $2,400 every month. Now let's take a look at the stocks. Luckily for me, I bought these four just before news of the vaccine was released. I was able to buy them while they were still very cheap, and since then, they've gone up a lot in value. Now let's check the other account. If you watched my last video, you'll remember that Enbridge was down $1,500 shortly after I bought it. And as time passed, it went down even further. At its lowest point, the value was down $2,700. I said in that video not to worry about the stock price. It goes up and down all the time. And I bet there were a lot of people who sold because they were scared the price would go down even more. Actually, I don't even need to bet. That's how the price goes down. People selling. But for those who didn't sell, they were rewarded, and as time went on, the price went up and up and up and up. As of today, Enbridge is up almost $500. And since that time, I've collected 2 quarterly dividends from them. This is another reminder that you should only sell if you need the money or if you don't believe in the company anymore, not because of the stock price. So my big holdings have already paid this month. In December 2020, I've collected $911 in dividends. That's amazing. But disclaimer, this is the month that Enbridge pays, and because they pay quarterly, I won't be getting the exact same amount next month. We'll have to wait 2 more months to get a full picture of the combined monthly dividends from both accounts. If you'd like to see that video, click the subscribe button so you'll be notified when I post it. As of now, my combined portfolio is worth $140,000, which is a 20% return on investment, and based on some rough calculations, I'll be receiving an average dividend of $700 per month. But like I said, come back in a couple months for a full picture of what's happening. Before I end this video, I want to respond to a question from the comments. A bunch of people have said this to me before, and when I saw this question, I wanted to address it. Chris L says, you might want to talk about taxes on the dividends and how interest on your debt is tax deductible. Thank you very much, Chris, for leaving a comment. For the first part of your question, paying taxes on dividends, I apologize, but I don't have any experience with this yet. Both my accounts are TFSAs, tax-free saving accounts. In those accounts, you don't pay any taxes, not on the dividends you receive or any gains you collected from selling shares. People should always first open a TFSA and max it out. What I mean by max it out is that there is a contribution limit of $69,500, and that limit is raised each year. In 2021, the new limit will be $75,500. Once you hit the contribution limit, then you can open up a cash account. This is a very basic investment account that doesn't have any tax benefits. So when you collect dividends or sell shares for a profit, you will have to pay taxes on them. Once I'm at that point, I'll be sure to address this question again. For your second question, how interest on your debt is tax deductible, again, this doesn't apply to a TFSA. You can't double dip.
Did you just double dip that chip? Excuse me? You double dipped the chip! Double dipped? What are you talking about?
If I borrow money to invest in a cash account, at the end of the tax year, I would have to total the gains from any shares I sold and total the dividends I collected and pay tax on them. This is when I would be able to declare the interest I paid on the loan and get a tax break. But in a TFSA, where I already get a tax break, I can't then apply for an additional tax break. The government doesn't let you double dip. Well, that's all for this video. Thank you for watching and making it to the end. If you enjoyed it or found the information useful, please hit the like button, which helps others find the video. Thank you all for watching, and until next time.